Hi. Just last week I was doing a Twitter for my new book, The Demographic Cliff, with some of our subscribers and followers. And I had an interesting question keep coming from a financial advisor. And he said, you're talking about Southern Europe and the bad debts there. Yeah, and the falling demographics, they get worse. Yeah, I could see that. Rising interest rates despite continued and escalated stimulus by the Fed and quantitative easing. Yeah, everybody sees that. But the last time, there's this subprime crisis, and that kind of came out of nowhere, and most people didn't see that. What's the thing that could be the surprise in 2014? Because frankly, as I've said in past videos and I cover in depth in this book, every major long-term cycle, intermediate cycle, and short-term cycle I have points down in 2014, and the broader cycles point down together for the first time since 1930 to 34, from early 2014 to late 2019 or so. So all we're looking for is a trigger. We know that governments are aware of the weakness of the recovery. I've heard Mario Draghi saying recently, you can just hear he's about to do another QE or LTRO, whatever they call it over there, and up the stimulus again. Japan and the US upped it in the last year or so. Japan went off the reservation. So governments are ready to move. The question is, what type of trigger would catch them off guard and cause a meltdown in an economy that they have overstretched? And that is their Achilles heel from my point of view. Not that they're not willing to stimulate more than any governments in history. Their Achilles heel is that very stimulus has perverted the free market system and has created more and more bubbles. And bubbles burst. And when they burst, they don't correct, they crash. And that's what I'm looking for, something that gets out of control. And here's what I think. Here's my answer to this person in this Twitter conversation. Emerging markets. The last time stock markets were bubbling up in 2007, you know what the leading indicator that said something was wrong? Housing prices, which we predicted back in late 2005 were peaking. Housing prices were going down even without the economy failing, and even though stocks were going up. And it was falling house prices that triggered the subprime crisis and a worldwide debt crisis that followed that, because things are so intertwined. Now, financial systems around the world are stretched more than ever. Bubbles have bubbled up in stocks more than ever. A lot of real estate markets around the world, not just in parts of the U.S. like California and New York and places like that, Miami, bubbled more than ever. Debt is higher in most countries than it was before the crisis. The whole world is primed for demographics to get worse, especially in Europe and just down the line in the United States. And every country around the world is going to go off this cliff. All we need, again, is a trigger. Here's the leading indicator I see this time, and boy, it's even clearer than before. Emerging markets. These are the countries with the best demographics in the world. Well, guess what? Their stock markets, if you look at them collectively, an ETF called EEM, they're down about 30% from their top in 2007 as developed countries, US, Germany, and many other countries are making new highs. They are down 20% from their secondary top in early 2011. Emerging markets follow commodity prices. That's what I've shown. I show in the book. I've shown in a lot of the recent issues of Boom and Bust in our newsletter. This is what's leading them down. Commodities have been falling since mid-2008. They rebounded, and they've been falling from lower levels since early 2011, and emerging markets are following them. And again, they have good demographics. But there's a bigger dynamic I call a vicious cycle. Commodity prices fall. Well, that hurts emerging markets, stock markets, and their best jobs in financial institutions, because that's what most drives their economy. They are commodity and resource exporters to the rest of the world. That's what they do for a living. That's how they earn foreign exchange and, again, create their best industries and jobs. Well, when they slow, China now exports more to emerging countries than they do to all the developed countries put together, and that's only rising in the future. So that causes China's exports to grow. China exports 35% of its GDP, and it's become the largest manufacturing country and region in the world, replacing the United States, Japan, and Germany in the past. So China slows down. Guess what? Their manufacturing machine requires buying a lot of commodities and resources from these emerging countries, so commodity prices go down further, and then that hits emerging markets and that hits China. You see how you get a vicious cycle. China has the greatest overinvestment, government-driven, overbuilding bubble. If we're printing dollars, they're printing condos and infrastructures and offices and malls and stuff way beyond what they need. 24% vacancy in cities, whole ghost cities with nobody in them. The largest mall in the world, double the size of the next largest, totally empty, now being used as a tourist attraction. I could go on and on. China's overbuilding. Their stock market is the clue. Their stock market peaked, another leading indicator, back in February of 2010 after the most feeble bounce of any market in the world, after one of the biggest declines, 70% in the last crash, even though they didn't have a recession, just slowed from 12% growth to 6%. China's been going down ever since and is back near its lows of early 2009 in the rest of the world. This is telling us China has a BS economy. China has high growth, but is driven by overbuilding that creates excessive overheads, excessive costs, and excessive debt, and now their private debt is bubbling up like the subprime crisis in the US did. I say it's going to be emerging markets, commodity prices, the great China bubble bursting that's going to trigger the next crisis in the world, a crisis big enough that no amount of money printing can solve, and they will be a little late to find out about this and to see it coming, just like the subprime crisis. So again, my cycles tell me this is the year. If we don't see a major crash by the summer of this year, and if it doesn't start by early May, then I'll reevaluate. But I say it's going to start this year. It's going to be a bigger crash than last time. We're going to see the Dow go as high as 17,000 in early 2014 and as low as 5,000 to 6,000 between 2015 and 16. This is not something you want to sit through. Emerging markets and commodity prices and the China stock market is telling us something's wrong with the world, and this is likely to be the surprise that nobody's looking for.